Good day. In today's report, attention is focused on growing uncertainty across global financial markets, particularly within the precious metals sector. Recent developments across multiple exchanges and geopolitical regions are drawing significant interest from market participants as new data points emerge regarding silver inventories, international pricing differences, and broader economic pressures. At the time of this report, silver in Western spot markets is trading at approximately $82. The metal recently moved down from a level near $84 and briefly touched around $81.90 before entering a period of consolidation. Short-term market signals remain weak and unclear, indicating that the immediate direction of price movement remains uncertain. While the paper market reflects this level near $82, pricing in Asian markets presents a notable contrast. Shanghai Futures closed at roughly $96, while Shanghai spot silver was recorded near $94. This places the Chinese market at a premium of approximately $12 above Western pricing. New data from the Shanghai Futures Exchange also highlights a significant change in inventory levels. On Thursday alone, the exchange reported a reduction of approximately 22 metric tons of silver in a single trading session, representing about 710,000 ounces removed from SHF vaults. Following that withdrawal, total silver inventory at the exchange stands at approximately 8,768,000 ounces. During the same session, silver on the exchange closed at 9,754, reflecting an increase of nearly 2% for the day. Other metals also recorded closing figures on the exchange, with gold at 5,192, platinum at 2,543, and palladium slightly lower at 1,929. These figures highlight a growing divergence between how different regions are pricing precious metals, particularly silver. Observers note that the Chinese market is not pricing the metal in the same way as Western exchanges. This difference has drawn attention because it suggests that underlying demand and physical market conditions may differ from signals coming from paper trading markets. Further data released by the Shanghai Gold Exchange provides additional insight into physical demand conditions within the precious metals market. According to the exchange's February withdrawal report, approximately 115 metric tons of physical silver were withdrawn during the month. When compared to historical patterns, this figure stands out significantly. The 8-year seasonal average for February withdrawals is approximately 62.5 tons, meaning the latest figure is nearly double that typical level. When the combined totals from January and February are considered, the numbers become even more notable. Withdrawals from the Shanghai Gold Exchange have reached a total of about 436 tons during the first 2 months of the year. This represents a record high for that period across the entire available data set, and is more than double the volume recorded during the same time frame last year. Additional weekly data from late February also reflects continued activity, with vault holdings decreasing by approximately 13,155 kilograms during the single week between February 23rd and February 27th. At the same time, similar movements are being recorded within Western exchanges. Data from COMEX shows that approximately 3 million ounces of silver were removed in a single session earlier this week. The withdrawals occurred across multiple custodians, including Asahi, Brinks, CNT, IDSD, and MTB. In addition to those removals, several 100,000 ounces were also adjusted out of registered status across 3 additional custodians. Following these movements, registered silver at COMEX now stands at approximately 87 million ounces, while total inventory has fallen to a fresh 1-year low. Meanwhile, COMEX open interest has declined sharply to around 112,874 contracts, representing the lowest level recorded since 2013. These figures indicate a notable reduction in participation in paper silver trading. Taken together, the simultaneous decline in inventories across multiple exchanges, including the Shanghai Futures Exchange, the Shanghai Gold Exchange, and COMEX, has drawn significant attention across the global market. Physical silver appears to be leaving vault systems in both Eastern and Western markets at the same time, while pricing differences between regions continue to persist. Developments within China's gold market are also adding another dimension to the broader precious metals picture. Reports indicate that 2 of China's largest banks, the Industrial and Commercial Bank of China and the Agricultural Bank of China, currently list investment gold bars as sold out on their mobile applications. Meanwhile, the Bank of Communications is no longer offering those bars through its platform. In the retail market, branded gold products in Beijing are reportedly selling for more than 1,600 yuan per gram. These developments suggest that both institutional and retail demand for physical gold in China is strong, with demand appearing to outpace available supply. While Western paper markets price gold near $596, physical market conditions in Asia are reflecting a different pricing environment. Attention has also turned to developments involving the trading firm Jane Street and its exposure to the SLV Silver Exchange Traded Fund. The firm's equity position is reported to have reached approximately $1.66 billion. In addition to that stake, Jane Street holds call options linked to nearly 40 million underlying SLV shares, valued at about $2.5 billion, along with put options on approximately 43 million shares, valued at around $2.7 billion. The combined options exposure therefore exceeds $5 billion, more than 3 times the value of the underlying equity position. Market data during the same period shows that implied volatility increased significantly from levels recorded in October, even as prices were rising. At the same time, short interest also rose, while borrowing costs remained relatively low and shares available to borrow increased. Observers note that this combination of rising price, increasing short interest, lower borrowing costs, and elevated volatility occurring simultaneously is unusual in typical market conditions. The custodian responsible for the SLV Exchange Traded Fund throughout this period has been J.P. Morgan. The bank previously agreed to a settlement in 2020, totaling $920 million, related to federal charges involving precious metals spoofing over an 8-year period. Beyond developments in metals markets, several geopolitical and economic factors are also influencing the broader global environment. One such development involves Venezuela. Reports indicate that an arrangement has been brokered by the Trump administration to import up to 1,000 kilograms of gold from Venezuela's state-owned mining company, Minervan. The transaction is being facilitated with the involvement of Trafigura, which will oversee the transport of the metal to refineries in the United States under a separate government agreement. According to the contract terms, the shipment requires a final gold content of approximately 98%, and the total value of the transaction could exceed $150 million for 1 metric ton of gold. The first ton is reportedly already moving. Another development drawing attention comes from Poland. The governor of the National Bank of Poland has proposed selling a portion of the country's gold reserves, which currently total about 550 tons. The proposal suggests that such a sale could generate roughly $13 billion to help fund defense spending as an alternative to the European Union's loan program for weapons procurement. The proposal has been presented directly to the Polish president. However, legal restrictions remain in place, and the Polish Prime Minister has expressed support for the European Union funding route instead, meaning the proposal is not yet certain to proceed. When the report first appeared, precious metals prices moved lower as markets reacted to the possibility of additional central bank supply. Energy markets are also experiencing pressure. West Texas Intermediate crude oil is trading above $78 per barrel, the highest level recorded since January 2025, and significantly higher than the lows seen in December. Reports indicate that Iranian forces have carried out strikes affecting regional energy infrastructure, and officials have publicly warned that oil prices could reach $200 per barrel if the conflict escalates further. The Strait of Hormuz remains a critical shipping route, carrying roughly 20% of global oil consumption, as well as a similar share of global liquefied natural gas trade. Additional developments have affected other parts of the energy market. Qatar's LNG facilities have reportedly gone offline following strikes, with restarts potentially taking several weeks. Coal futures have also surged more than 8% in a single trading session as markets shift toward alternative fuel sources. At the same time, Russia's president has publicly discussed the possibility of redirecting pipeline gas supplies away from Europe. Meanwhile, global financial markets have shown mixed performance. South Korea's Kospi index rose sharply by about 9.6% following a historic sell-off. However, other major markets recorded declines, with Germany's DAX down roughly 2.5%, while the S&P 500, the Nasdaq, and Bitcoin also moved lower. The latest economic data from the United States also influenced trading activity. Initial jobless claims were reported at 213,000, compared with an estimate of 215,000. Continuing claims came in at approximately 1,868,000 against an estimate of 1,845,000. Following the release of that data, the US dollar strengthened, and paper precious metals prices moved lower during the session. These developments together illustrate the complex conditions currently shaping global financial markets. Movements in physical metal inventories, geopolitical developments, global energy markets, and economic data releases are all contributing to the environment that investors and analysts are monitoring closely as conditions continue to evolve.